All right, today we're going to tear down a financial report to see what makes a modern digital company tick. We're going to get right into the anatomy of a real digital powerhouse and figure out how they pull off these just incredible results. Let's get started. So, before I even tell you the name of the company, let's just ask a simple question. What does hypergrowth even mean when you strip away all the buzzwords? What does it look like on a spreadsheet? Let's look at the raw data. First up, just try to wrap your head around this. Growing your total sales by over 35% every single year for 5 years straight. That is just relentless, consistent growth. But here's where it gets even crazier. Their profits grew even faster. We're talking an average of almost 43% a year. This tells you they're not just getting bigger, they're getting smarter and more profitable with every dollar they make. And then there's this number, return on equity. For investors, this is a huge signal. A number this high, 28.5%, basically screams that the company is a master at turning shareholder money into pure profit. So, who is this company? Well, these are the numbers for Affle, a global mobile ad tech company that you've probably never heard of, but whose technology has almost certainly been on your phone. So now, let's pop the hood and see how this engine really works. First things first, we've got to understand the engine. The business model. I mean, how on earth does a company in the super crowded ad tech world post numbers like the ones we just saw? Well, it really boils down to three core pillars that all work together. First, they have a platform that figures out what we, the consumers, are doing online. Second, they use that intel to power something called programmatic advertising. And third, they deliver actual measurable results to their clients through performance marketing. Now that term, programmatic advertising, it's super important. All it really means is they use smart, automated software to buy and place ads in the blink of an eye. It's about getting the right ad to the right person at the perfect moment, all without a single human needing to pick up the phone. It's like the stock market, but for ad space. So what's stopping everyone else from just, copying them? Well, the report calls it their technology moat, and it's built with things that are really hard to replicate. Their own unique machine learning, a giant library of consumer data they've built over years, and deep, deep connections into all the major ad platforms. It's a powerful defense. Okay, a great business model is one thing, but you gotta have the numbers to back it up, right? So let's shift gears and look at the proof, the financials that create this company's rock-solid foundation. And this, right here, might be the most important part of their financial story. The report points out their virtually debt-free operations. Just think about that for a second. In an industry where so many tech companies borrow tons of money to grow, Affle is building its empire using its own cash. And here's the number that proves it, a debt-to-equity ratio of just 0.08. To put that in simple terms, for every $100 the owners have in the company, there are only $8 of debt. That is an unbelievably low-risk way to run a business. And when you put it side by side with a typical competitor, the difference is just staggering. This kind of financial discipline gives them so much freedom. They can invest in growth, they can survive a bad economy, all without worrying about what the bankers think. And let's circle back to that return on equity number from the start. A 28.5% ROE is incredible. It just means the company is an absolute machine at turning its own money into more money. For every $100 invested, it spits out almost $29 in profit each year. That's the sign of a truly high-quality business. So, you've got this powerful business model, a balance sheet that's like a fortress. What's next? Where does a company like Affle go? From here, let's take a look at their roadmap. The first thing to get is that Affle is already a massive global player. A huge 65% of its revenue comes from outside its home market. So this isn't just an Indian story, it's a global one, with really deep roots in some of the fastest growing economies in the world. And their strategy is basically to double down on what's working. The plan is crystal clear. Keep winning in Southeast Asia, push hard into the Middle East, and then start tapping into the massive, massive potential of key markets in Africa. But it's not just about geography. They're also future-proofing their technology. They're pouring money into AI, building new tools that respect user privacy, jumping into the booming world of streaming TV ads, and connecting their systems directly into e-commerce. Okay, so we've seen the engine, we've seen the financials, and we've seen the roadmap. So what's the final call from the report? Let's get into the verdict and weigh the risks against the rewards. The analysis lands on a very clear buy recommendation, and it suggests there's a lot of room for the stock to grow. But, as you know, a simple recommendation is never the whole story. We've got to understand why. This little table is absolutely crucial. See that PE ratio? Yes, Apple is more expensive than its peers. The market makes you pay a premium for it. But then look at the other two columns. Its growth and its profitability are just on another level. You are paying up, but you're paying up for superior performance. And this really shows you the two sides of the coin. The bull case is all about their market leadership and the huge global opportunity. The bear case? Well, it's all about that high price tag plus the risks of competition and ever-changing government regulations. So, to boil it all down, the key risks are pretty clear. They depend on the big tech platforms, they face brutal competition, privacy laws are always changing, and there's that valuation risk. The danger that the company just can't live up to the sky-high expectations that are already baked into its price. Which really brings us to the final question, doesn't it? Apple is a textbook case of amazing execution and financial strength, but it operates in a world that changes in the blink of an eye. And it leaves you wondering, in a world that moves this fast, what's the real price you have to pay to stay ahead of the curve?